Welcome to the Daily Drawdown, where oil shocks, chip capital, and market stress set the tone. The biggest practical shift today is simple. Energy risk is back in the price stack, and it is bleeding into freight, inflation, rates, and sector leadership. At the same time, AI spending keeps accelerating through debt and silicon deals, even as markets start asking harder questions about valuation, financing, and competition. The Iran ceasefire framework is effectively gone after President Trump declared the Memorandum of Understanding over on the NATO floor, catching allies off guard and raising the temperature fast. Washington also revoked waivers that had allowed Iran to sell roughly 130 to 150 million barrels of oil, which removes a meaningful revenue outlet and tightens sanctions pressure immediately. So far, the military picture still looks more like a prolonged low-grade standoff than an immediate full-scale war, with U.S. strikes and retaliation focused on assets tied to shipping harassment. What matters now is choke point risk, export disruption, and whether Turkey can convert its summit host role into a real diplomatic channel, because Ankara looks like one of the few plausible intermediaries left. Markets reacted exactly where you would expect. Brent jumped about 5% in a day. WTI ran 6 to 7% toward the mid-70s, and traders are watching the $80 Brent level because that is where short covering could accelerate the move. This is not just crude. Refining margins have tightened hard. The 3-2-1 crack spread has surged from about $20 to roughly $60 year to date. European gas rose around 8%, and distillate inventories are still running about 12% below the 5-year average. The International Maritime Organization raised transit risk for the Strait of Hormuz. Some operators are recommending avoidance, and insurance costs are climbing. If toll demands or rerouting threats become more serious, tanker capacity gets tighter, and delivered energy costs go higher again. Freight is already flashing stress. China to U.S. West Coast container rates have jumped from roughly $1,800 to about $7,100 per container, which is a direct margin hit for importers and another inflation channel into consumer goods. One more constraint here. U.S. refined product exports are at a record roughly 8.7 million barrels per day, while strategic reserves are still lean by historical standards. That means the system has less cushion if the standoff drags on. At the NATO summit, the practical headline was the push for members to get to 5% of GDP in defense spending by 2030, with roughly $50 billion in procurement announcements showing that some pledges are turning into actual orders. Trump's public attack on Spain for missing the target rattled allies and briefly hit Spanish markets, including a move higher in yields. For investors, the key second-order effect is procurement mix. As Europe expands its own defense industrial base, more spending may stay with European suppliers, which could cap upside for some traditional U.S. contractors in certain programs. The financing side of the AI build-out is getting harder to ignore. Bank of America sees AI-linked debt issuance around $270 billion this year, roughly double last year, driven by data centers, compute, and network build-outs. Amazon is the clearest example. It sold a $25 billion bond package, including 30 and 40-year paper above 6%, and commentary tied as much as $54 billion of recent debt to its AI spending plans. SK Hynix also raised heavily, and the broader concern is supply. If too many large issuers hit the market at once, investors may demand higher yields to absorb it, which raises financing costs well beyond tech. Treasuries did show some resilience with a solid 10-year auction around 4.58% and strong demand, but the message is mixed. There is still a bid for duration, just not an unlimited one. That matters because the Fed is unusually divided. Minutes showed one of the sharpest splits in decades, with members divided between holding, cutting, and hiking, as they argue over inflation stickiness, oil shocks, trade policy, and AI-driven demand. There is also a communication shift towards speaking less and potentially downplaying the dot plot, which means markets may have to price incoming data more directly and with less guidance from the Fed. In plain terms, if energy stays hot and issuance stays heavy, rates volatility probably stays elevated too. On semis, Apple committed about $30 billion to Broadcom to produce more than 15 billion US-made chips and develop Apple's first dedicated AI server chip for cloud workloads. That is important beyond one contract. It supports domestic silicon capacity, lines up with broader US industrial policy, and highlights the real bottleneck now: skilled labor and fab execution, not just capital. It also reinforces the custom chip story. Analysts expect Broadcom to take a large share of the custom AI server ASIC market, helped by close relationships with hyperscalers that want specialized designs. That does not erase NVIDIA's position, but it does make the competitive picture less one way. NVIDIA's forward multiple has compressed to around 18 times, with bulls saying demand is intact and bears pointing to custom silicon and broader multiple reset risk. Elsewhere in memory, Micron drew tactical buying after a steep sell-off, while weakness in South Korea's market matters because Korea still sits at the center of global memory supply. Underneath all this momentum has been unwinding hard. Goldman described a 5-day drawdown in momentum factors as unusually severe, pushing many of the crowded winners below short-term trend levels. The rotation has favored cheaper cyclicals and defensives like financials, healthcare, and utilities, while also reopening the case for smaller caps and some emerging markets that were left behind during the AI megacap run. Options flows show how traders are expressing the new regime. Call buying in oil ETFs picked up, airline downside hedges increased, and there were outsized bets around Delta as traders priced a bigger-than-normal earnings move. Space is also turning into a larger capital and security story. Blue Origin reportedly raised $10 billion at about a $130 billion valuation, while SpaceX remains capital-intensive, even with stronger underlying economics from launch and Starlink. The bull case is lower launch cost, high-margin connectivity, and a huge market for space-based AI and communications. The risk case is debris, militarization, jamming, deorbiting, and a much more contested operating environment than many commercial models assume. That same financing lens applies to OpenAI as well. Large fundraising plus long-dated cloud commitments can look manageable in easy markets and much heavier if funding conditions tighten. Biotech has a real tailwind from pharma patent cliffs, with about $96 billion in deal activity this year as buyers hunt pipeline assets. Walmart is getting attention as a defensive consumer play after price rollbacks, with the argument that value positioning matters more as households stay price-sensitive. In energy equities, some still like APA on valuation and discovery upside, especially if higher crude prices hold. And on governance, investors are staying alert to reputation risk at high-profile AI and defense-linked firms because messaging missteps can become valuation issues quickly. The near-term watch list is straightforward. Brent near 80, transit risk through Hormuz, corporate debt supply, and whether chip spending keeps broadening beyond the usual leaders. You're listening to the Daily Drawdown. That's the brief. This episode was generated by Podkey. Create your own at podkey.fm.